The language of business following a transaction from event to record. In this video, we are going to deep dive in the accounting principles and practices. Every business actions create a financial records. We all know that each and every bookkeeping or the record to report any financial activity starts with a single business transaction. A business transaction is any economic activity that involves the exchange of money or money worth and affect the financial position of a business. Only transactions that can measured in monetary terms are recorded in the books of accounts. So, in order to record in the books of accounts, we require to keep some kind of supportings in the form of invoices, cash memos, receipts, debit note, credit note, vouchers, check, counterfoils. This will create the authenticity, accuracy and legal evidence of those transactions. The journey from a single event to a permanent record. First one, the journal. The first official entry. A journal entry is the systematic chronological recording of a transaction showing the accounts affected and the debit and credit amounts. It is the original entry in which business transactions are recorded for the first time. So it is a systematic way of recording the transaction with the affected accounts and debit and credit amounts with ending a brief narration. So while recording a transaction, we should follow some criteria. The journal entry first starting with the transaction date, then the affected accounts, then goes to the debit and credit amounts and ending with a brief narration. Step 2. Posting to the ledger. Classifying the story. A ledger is the principal book of accounts where transactions are sorted and posted account-wise. The process is called posting. So, what is a ledger? A ledger is the principal book of accounts where the transactions from the journals are classified and posted account-wise. It shows the net result of each account balances and forms the basis of preparing the trail balance and final accounts. Posting is the process of transferring journal entries into the respective ledger accounts. In the posting, each transaction recorded in the journal is classified and entered into individual accounts in the ledger. Step 3. Balancing the accounts. Finding the bottom line. Balancing means finding the difference between the debit and credit side of an account to ascertain its final balance. Balancing means finding the ending balance between it is normally the difference between the debit and credit side of an account to ascertain its final balance. The guiding principle. Universal rule for a trustworthy system. To ensure that the story of every transaction is told accurately and consistently, accountants follows a set of fundamental principles. These are not arbitrary rules, they are the bedrock for every financial reporting. We will explore them in 3 key groups: the core framework, the rules of timing and value, the principle of integrity. First one, the core framework, defining the business and its language. It starts with business entity principle. The business entity principle states that a business is treated as an entity separate and distinct from its owner for accounting purposes. As a result, only business-related transactions are recorded in the books of account, while the personal transactions of the owner are completely excluded to ensure clarity, reliability, and unbiased financial reporting. Second one, money measurement principle. According to the money measurement principle, only those transactions or event that can be expressed in monetary terms are recorded in accounting records. Non-monetary factors such as employee efficiency, customer satisfaction, and managerial expertise are excluded, even though they may significantly influence the overall performance of the business. Third one, dual aspect principle. The dual aspect principle states that every business transaction has two and equal and opposite effect of the accounting equation. This concept forms the foundation of the double entry system, ensuring that total debit always equal to total credits and the accounting records remain balanced. The role of timing, measuring the performance in the right period. This key group include 4 accounting principles, includes going concern principle, accounting period principle, accrual principle and matching principle. Going concern principle. The going concern principle assumes that the business will continue its operation for the foreseeable future and has no intention of liquidation. Based on this assumption, assets are recorded at the cost and depreciated over the useful life rather than being valued at the liquidation prices. Second one, accounting period principle. Accounting period principle means that the continuous life of a business is divided into uniform accounting periods, usually 1 year, for the purpose of measuring financial performance. This enables stakeholders to periodically assess the profit or loss and evaluate the financial position of the business at a regular interval. Third one, accrual principle. Under this principle, revenue are recorded and recognized when they are earned and expenses are recognized when they are incurred, irrespective of the timing of cash inflows and outflows. This approach provides a more accurate and realistic measure of a business financial performance during a specific accounting period. The last one, matching principle. The matching principle requires that expenses incurred to generate revenue in a particular period must be recorded in the same accounting period as the related to income. This ensures that the correct determination of the profit or loss and prevent to distortion of financial results. Subdivision of second key group, the rule of valuation. Determining what something is worth. It includes two accounting principles called historical cost principle and revenue recognition principle. Historical cost principle. Assets are recorded at their original purchase cost. Subsequent changes in the market value are not recorded, ensuring objectivity and verifiability. Traditionally, assets are recorded at historical cost to ensure reliability and objectivity. However, modern accounting standards require certain assets and liabilities to be measured at fair value in order to reflect current economic realities and more accurately. A note on modern practice. While historical cost is traditional for reliability, modern accounting standards may require certain assets to be measured at fair value to reflect current economic conditions. Revenue recognition principle. Revenue is recognized when it is earned and when the significant risks and rewards are transferred to the customer, not just when cash is received. That means revenue should be recognized when it is earned and the significant risk and reward of the ownership is transferred to the customer. Mere receipt of the cash does not determine revenue recognition, as the focus is on performance and the obligation fulfillment. Normally, revenue recognition is a 5-step model. It includes starting with identifying the contract, identifying the performance obligation, determining the transaction price, allocate the price, revenue recognition when obligation is fulfilled. The last topic in this video, third and final key group, the principle of integrity, ensuring a cautious and complete story. This key group includes 5 accounting principles: conservatism or prudence, full disclosure principle, consistency principle, substances over form, and finally materiality principle. Conservatism or prudence principle. This principle of conservatism states that anticipated losses should be recognized as soon as they are foreseeable, whereas anticipated gains should not be recorded until they are realized. This cautious approach prevents the overstatement of income and assets, thereby protecting the interest of users of financial statements. Second one, full disclosure principle. The full disclosure principle requires that all material and relevant information relating to a business financial performance and position be disclosed in the financial statement. This includes notes to accounts, accounting policies, and contingent liabilities, ensuring transparency and informed decision making. Third accounting principle, consistency principle. Once an accounting policy or method is adopted by a business, it should be applied consistently from one accounting period to another. Consistency enhances comparability of financial statements and allow users to identify meaningful trends over time. Substances over legal form. According to this principle, transactions should be accounted for based on their economic substances rather than their legal form. For instance, assets acquired through a finance lease are treated as owned assets even if legal ownership has not formally transferred. Last principle in this video, materiality principle. Materiality refers to the relative importance of financial information in influencing the decision of users. Items that are material in nature must be disclosed separately, while insignificant items may be aggregated to maintain simplicity without compromising the usefulness of financial statements.